My overall returns over the last 30 odd years are about over 16% IRR. The last few years have been tough. I mean, my IRR was about 18.5 until 2021. I peaked in 21 in April. And then I had a bad year in 21, down 7%. I was up a couple of percent last year and the year before. And this year I'm having quite a good year. I'm up. Well, I've peaked at 12.5% on June the 3rd, but I've come off a bit. Markets have been weak in the last couple of weeks. So I'm now just under 10% up for the year to date.
Oh, brilliant! That sounds. You sound so over the long term. You've certainly made a bit of money there, to say the least. And how do you run a sort of portfolio? Is it sort of quite concentrated, or is it sort of like how many stocks do you own, or typically in your portfolio?
More than I've ever owned before. So for long periods I was probably at 10, 12, 15. But as I've got older and more risk averse, and because the money I'm managing is so much greater than when I did at the start, it's now grown to about 35 stocks, which is too many.
Okay, we've done really well to sort of like to carry on those sort of double-digit returns anyway, sort of long term with that number of stocks. And we've got a sort of like a general election happening, and any sort of like top level risk that investors should think about. I mean, we had a statement from Traxys yesterday, who are effectively a rail software company in the UK, but also branching out in the US, and they said they'd actually got a bit of slippage in sort of orders for theirs. Any other sort of like areas that would be, people should watch out for because of potential disruption for the general election?
Well, I think there's a whole range of sectors that are affected at the moment. I mean, people are talking, property is definitely one of them. Estate agents are saying the market was getting better, but now in this run up to the election, it's really just on hold, and people are waiting to make their minds up, probably more so at the top end than anywhere else. But yeah, there's obviously risks involved. One would have thought, though, given the scale of the Labour lead in the polls, that a lot of that has already been priced into the market. Otherwise, we've got to assume markets are highly inefficient, and I don't think on this they're particularly inefficient.
Yeah. No, I think you're right, and also one angle. If you assume that Labour is going to win, which just looks like an absolute, with a big majority, one thing which actually does seem to have come out from the election or from the run-up so far is that the Labour Party seems to have decided to hold, sort of like have a strain on its spending plans and also tax raising plans, and on that basis I think the market and investors overall have got pretty comfortable that it's not going to be a sort of like a Jeremy Corbyn type thing. It's going to be more of a Gordon Brown stroke Tony Blair type economic outlook in terms of making sure that we don't get a Liz Truss bombshell. Don't know what your thoughts are.
I'm skeptical.
Oh, I see.
So I don't think Starmer is the finished product. I don't think he's a Blair or a Brown. I mean, look at the government's plans to create Great British Energy or to renationalise the rail franchises. There is a look through the manifesto. There's not a lot of new thinking. It might be new thinking for a younger generation, but for old cynics like me, we've seen it before. And I suspect Labour will revert to being a tax and spend party over time. But it's very difficult. I mean, I've no idea who to vote for in this election.
Yeah. Well, I think actually the market seems to be comfortable that it isn't going to be a spending tax. But you're right. Well, that will be wait and see. At the moment, I think they're trying to follow what the lip service from the Labour Party. If just to the audience, if anybody wants to ask Leon any questions, then please put them in the chat. But we've had one already. Patrick Leahy, he says, looking forward to hearing the interview. Could you your best thoughts on Journeo? He's interested in your view. They basically do sort of like software and services for the rail industry. It's headed up by a pretty experienced CEO, Russ Singleton, and I think they've won some pretty big contracts over sort of the last 2 or 3 years. The order book's increasing, trying to increase their margin. You can take us through your latest view on this one, because I guess there may be a look across from Traxys from yesterday.
Yeah, I mean, Journeo should do well under a Labour government, although that's not been reflected in the price of late, which has come off its recent highs. I'm very positive about Journeo. I've been to see them twice now in the last 6 months. I really like that kind of solid, honest management. And, they've been winning lots of contracts. They've been pushing the business further into the area of software as a service. I think this year, so far, they've not announced any big contracts that have surprised the market or weren't reflected already in their projections. Possible negatives are that their contracts are relatively short term, typically 1 to 3 years. The business that they acquired at the start of last year, Infotech, I'm pretty sure that they're not going to get the extension on the MTA contract. This is a contract that they had to fit their screens into trains under the MTA in America. But those weren't reflected in the projections anyway. So I don't think, I think it'll be disappointment more than anything else if that is confirmed. But generally, I'm very positive. I mean, they've taken a long time to turn that business around, but they've made sure and steady progress, and I think they're going to continue to do well.
Yeah, and they trade. It's about 11.5 times PE. They've got cash on the balance sheet. Is there an opportunity that they can sort of like start that dividend maybe?
Possibly, but I think that they're probably, if they've got it enough, they're probably looking at small acquisitions, fill-in acquisitions.
Yeah, and you don't see any disruption at all, like from Traxis. I mean, I know they work in slightly different areas, more nichey, isn't it? Sort of, it's your ticketing and also displays and stuff like that, rather than your sort of, the productivity type of scheduling software.
Yeah, I haven't followed Traxis too closely since John, and you'll remind me of his surname, the former Dynamics CEO left the business. So I can't really comment, but as you've said, they're already saying that they're experiencing some short-term headwinds, but I'm sure that'll pass.
Yeah. I think they're a different area as well. So good. Okay, well let's move on to the sort of the fund managers, not the fund managers, into the sort of the investment platforms. We've got Hargreaves Lansdown and AJ Bell. And what was interesting, apparently, because I was presenting on Thursday morning down at Mello last month, and apparently you were on the bash right at the end. And in the middle of your presentation on Hargreaves Lansdown, there was a takeover approach. So well spotted. But what's your latest on this one? Because it has been, the shares haven't performed a great deal, sort of like the last few years, but they are pretty much undervalued. Yeah,
I mean, what struck me about Hargreaves was that this has always been a business that I wanted to own, but was always felt too expensive. And it's it has those high operating margins and high returns on capital, a dominant market share, 42% of the market. They're the things I like. But under the previous management team, that entrepreneurialism of the early Hargreaves had turned into a kind of managerialism. Its annual report was growing at about 15% at a rate of return in terms of the length of it, because they were covering all bases except some of the more important ones, which were to do with service and remaining competitive. But it's got a very strong position in the UK market. It was trading, I think, when I first looked at it, at about 11 times earnings. I might be wrong on that, but it was certainly low.
Yeah, that's about right. Yeah.
And the shares, had come off from the high 20s during COVID to around £7.20 when I bought in. So when I did a presentation at Mello last November, I highlighted it, and then my thesis for the recent Mello was that whereas all the other brokers that I identified on a comparative valuation slide that I did had gone up considerably since last November, Hargreaves Lansdown, which had gone up a bit, was the real laggard, and that I still felt that on a comparative valuation basis it was super cheap. So actually a PE rate before the bid 11.5 times compared to AJ Bell at almost 20, Schwab at 23, Interactive Broker at 19 times, and the famous or infamous Robinhood trading at close to 40 times profits. At least now they're profitable, Robinhood, which has to be said. How things will pan out from here, it's difficult to know. I mean, this was a consortium of 4 private equity providers, and I think it's as unlikely for 4 private equity providers to get on with each other as Tory cabinet ministers. I mean, it really would be quite rare. So we'll have to see how far that bid goes. And obviously, private equity can only go so far when it comes to sort of price. They generally have to look at other things like debt repayment, etc. So I'm hoping that it will open up the business to others to look at it more closely. I think Peter Hargreaves is keen for change. He wants to see some of that entrepreneurialism come back into the business. So I'm still confident that things will happen. In fact, I bought more, added to my position after the announcement of this recent takeover. But one issue, I think, as a Hargreaves customer myself, with private equity, you don't want to have a situation where your platform provider is stuffed full of debt, because one of the reasons I go to Hargreaves is I can sleep easy at night. I don't want to use a small broker and have significant parts of my investments and savings tied up with them. So I think any buyer of Hargreaves has really got to think through carefully this whole debt question that they want to put into the buyout structure, because otherwise I think people will look. You will see some movement across to other platforms such as AJ Bell.
Yeah, and that's a really good point, actually. Yeah, the acquirer has got to reassure its customer base that actually, it's not going to actually just lever it up at like 5 or 6 times EBITDA. Well, what's interesting also, I mean, sort of like in terms of the actual bid, I mean, I think the Abu Dhabi bid was at what, £9.85. The shares are currently trading at over £10, which suggests that the share price has lost none of the bid premium. In fact, has put an extra bit in on top, which suggests that actually the market, in people, the smart money supposedly, is expecting another bid.
Well, I'd have thought so. I just don't think the shareholders will sell out in the £9 region. I mean, you've got a lot of investors who came in at the £20, £25 area.
Yeah.
Are they prepared to take a loss? Of course, the world looks completely different when you come in at £7. But I don't think most investors have come in at £7 like me. So I'm thinking £12.50 plus. I'd be delighted. Yeah. But there are those who are saying they wouldn't sell for less than 15. So somewhere along the lines, you've either got to back the existing management and its strategy, and I'm not convinced, or you accept a price that is in the teens certainly. And accept, if you've bought in, I accept loss. Now, there may be an opportunity, as there is sometimes in these situations, of rolling your investment into the buyout vehicle and participating in the deal. Now, this is a very big deal, potential deal. That might be tricky given the number of parties involved, but certainly I've had experience of that in the past. A company called Deal Logic, which I owned. And I was able to roll over into the buyout vehicle, which then was subsequently sold at a higher profit later on. So I sort of double dipped there, benefited from the original offer and then later from a second resale.
Yeah, well done. That's going to be a fascinating situation. Okay, let's move to another stock in that particular sector. We've got AJ Bell, as we talked about, which actually the share price has perked up on the back of that bid, I think, from Hargreaves Lansdown. But also more broadly, the markets are getting better. And obviously these platforms, if there's more trading, will make more money from fees. And likewise, any sort of assets under management they have on their own sort of discretionary funds, then they'll make it as a percentage. So things are sort of like moving in their direction. Plus, I suppose there is a secular trend in terms of investors want more investors doing DIY because there's no defined benefit pension schemes. But anyway, what's the latest on to AJ Bell? It's slightly more expensive, I believe.
Yeah, it's more expensive, but it is it's still controlled by the entrepreneurs that created that business. It's growing faster than Hargreaves, albeit from a smaller base. Their product is probably more balanced because they came from a pensions background. They're much stronger on SIPs than Hargreaves. So there's a lot to like about the AJ Bell business. I mean, part of the weakness recently, despite the partly because of the decline in the market in the last 2 weeks, has been that one of the founders sold down some shares in a placing 2 or 3 weeks ago at about, I think it was 375. I might be wrong on that, but it was certainly and the shares were over £4 at the time. So
Mr. Bell, I think, isn't it?
Right.
He banked 28 million quid.
Yeah. Beach money, I think they call that.
Yeah, I wish I had some pocket money like that.
But he's done great things, and I suppose he's also conscious of the fact that with a possible change in government and higher capital gains taxes, there's been no commitment by Labour that they won't increase capital taxes or introduce a wealth tax. They've really focused on income. So I think it was wise for him to sort of take some money out.
Yeah. Which one of the two do you prefer, as in like AJ Bell or Hargreaves, or just equally on both because it's a slightly higher quality, faster growing asset?
Well, in some ways, my biggest regret is that when I did my first presentation to Mello last November, I didn't buy both. I ended up buying Hargreaves. It has done better now because of the potential takeover offer. But I think if I was coming into it for the first time, putting aside the takeover offer, I'd probably put my money into AJ Bell over Hargreaves, despite the higher multiple, etc.
Yeah. Okay, good. We've got another question. We've got Nicholas Slater. He's asking about Spectra Systems, which I think is an expert of all things banknote authentication, sort of like making composites and putting them into printing currencies, etc. I guess the key question is sort of like, what is the secular growth in that business, given people are moving towards sort of digital payments? But it does look like a pretty high quality asset. In fact, it trades at about 20, if I read this right, about 20 times PE. So it's not that cheap, but I guess it makes good margins. What's the latest on Spectra Systems?
Well, I like it. I own and have owned shares in Spectra for a long time. Not as many as Nicholas Slater, I should add. Is
he a big investor, is he?
He's really got this right. If it's the same Nicholas Slater,
I think it must be. Yeah,
he really had great insight here with Spectra Systems. I like the business, but I suppose one thing that's always held me back is this fear about banknotes. I don't carry any banknotes on me. I don't carry any coins on me, and my children and my wife, none of us use very little paper money. So I've had to overcome that bias. In fact, when I presented at Mello, when somebody else was presenting on Spectra, and I asked the audience how many of them had banknotes in their pocket, and I was very disappointed because I was going to use this as a slightly bearish argument on Spectra, that almost 90% of the people in the audience had cash on them. Now, they were an older demographic than certainly my children's generation, but if one looks into the very long term, I can't see a future for banknotes. But these things take decades. They're multi-decades changes, and banknotes aren't just produced in this country; they're produced throughout the world. Mm-hmm. And there will be many countries that just aren't ready to move to digital currencies for a very, very long time. In the meantime, Spectra are hoping to join the two sole producers of polymer banknotes. Polymer notes are growing by about 18% per annum. At the moment, it's just CCL and De La Rue that produce polymer notes. Now, Spectra have developed the only note where they can print the security features into the polymer. These other companies, they print on top of the polymer. So the Spectra solution has significant advantages. They acquired a company called Carter for just 10.5 million at the end of 23, which now allows them to in-source security printing for polymer notes. And they've got a trial with a large Middle Eastern bank, and others are watching that closely. So I think my experience with Spectra over the last decade or so has been that it's a quality management team. They've produced, I think, 18 upgrades in earnings in the last 7 years and never a downgrade. That there is a key risk risk there. I've only ever met the CEO. They're a US-based firm, and so I would say the two key risks are the future of banknotes and key man risk. but I think there's a great deal of potential. And they're also building at the moment 300 sensors for a large G7 bank. It's a part of a big replacement cycle. They're going to be making exceptional profits over the next 2 or 3 years. One person has, or WH Ireland have said, about 42 million of cumulative profits between 24 and 26, and cash up from 7 million to 24 million by 2026. So I think, you know, there's still a lot of potential in this company, and I think the future is definitely, the immediate to medium future is polymer. Maybe long term, it's digital.
And presumably you could use the technology for other to authenticate other assets. I mean, anything that uses that, we can incorporate that polymer, which is a valuable asset. I mean, you may even, I mean, who knows? But you know, there's so much sort of knockoff handbags, shoes, and all the other sort of like, you know, physical goods, which, or even jewelry or whatever. Then you could sort of like, you know, put it, incorporate it in that particular product to make sure that it's authentic, I guess.
Yeah, I mean, that's right. They already do a lot of that authentication work. And I mean, they were very hopeful of being able to offer a solution for the authentication of cigarettes in China, which is a big smoking community. I don't think that's been as successful. I think they're sort of moving. They're moving to where the money is in terms of.
Yeah. Well, actually, I'll tell you, the other place they should have a look at. I know it sounds crazy, but is the vaping devices, because you get 25% of vaping burners, I believe, which are counterfeit. They're all illicit, so you know that would be good. But anyway, that's a separate issue. Okay, let's move.
And all those young people lying flat down at my local, flat on the floor in my local village.
Yeah, no, exactly. Yeah, no, they've got cannabis in there, haven't they? Okay, good. Let's move to stay in the financials. We've got Barclays. Now, this is a really sort of like, I don't know, battleground stock for years. It's one of the big high street banks. It's always traded at below, or has in the recent years, below net tangible book. And people, so you got one side of it can't get their head around in terms of, you know, is it a value play or is it a value trap? And it's sort of like getting consistently that return on tangible book above 10 or 15%, isn't it? But what's sort of your latest on this one? Because it has just been it's always seemed very undervalued.
That's right. But I presented the Barclays idea I've set up a local Signet group. This is a group of investors who meet in a particular area. We've got a West Sussex group. In fact, if anyone is interested who lives in West Sussex, please contact ShareSoc. But I put forward Barclays, and they'd assumed that I was a rational and successful investor, and they almost to a person fell off their chair.
Leap of faith, that one, Leon.
When I suggested Barclays for the Signet share competition, which is run across the country with 20 or 25 different regions competing. I have to say the West Sussex group, it's only a month in, but we're leading at the moment, but not because of the Barclays idea, although it is up about 6%. Why do I like it? Well, the PE ratio is low, 5.9 times, falling to 5.3 in 25. Dividend yield of 4.3. Now, if you look at Stockopedia, it says that its return on equity, tangible equity, is 6.1%. But the accounts talked about 10.6%. And that's because management take it before restructuring costs. But one of the reasons why the share price has been very strong of late, it was sort of around £1.40, £1.50 for a long time before breaching £2, is that management announced a major restructuring which would culminate in 2026, and no doubt that's the reason why they have some structural costs going through. Now their target for 26 is 12.5% return on tangible equity, but of course we're not paying the tangible equity price to get involved in Barclays. We're not paying a pound for a pound. You know, you can today buy Barclays at just 49% of its tangible book value. So forget goodwill for acquisitions and other things. This is just its tangible book. You're buying it at half of its.
I think I think the tangible book, the last I had, it was £3.35. It's tangible. Its book value is higher, but its tangible book is 3. Oh, is it?
No, well, if I've got this wrong, I mean, it's the figure I've been relying on, but its tangible book value is definitely at a discount to its share
Oh,
price.
yeah. No.
And if you take the 12.5% target return on tangible equity and divide it by the 0.49 that you're able to buy it at, effectively you're getting a 25.5% return on your own invested capital, because you're not having to pay a pound for pound. You're only paying 49p in the pound. But you've slightly unsettled me by telling me that tangible book value is higher. But
No, it's low. It's I think the book value is over £4, which gets to your 50% discount.
Yeah.
Whereas I think the tangible, but it's still, let's be clear about it. We're splitting hairs here, because we're still looking at sort of like a 40% discount. So there's not actually that much difference.
So in that, so if you can get a 20 to 25% return on your invested capital, those opportunities don't come around very often, and I think it's great value. Now, my bigger thinking is that banks have been under the cosh really since the great financial crisis. They've regulation, they've been heavy regulation. Interest rates have been ultra low for most of that period. Banks have been starving really, and now because of rising interest rates, they're sort of earning a lot more on their net interest margin, and the businesses are beginning to sort of come to life again. It was like a desert, and it's raining now on the desert. Now, I'm not saying interest rates are going to stay where they are. They look very likely to be falling, but I still think that they're going to end up at a higher level than they were for that period of 2008 through to 2022, 23.
Yeah.
So I think better days are ahead, and I like buying a stock that everybody else hates, and particularly if I'm getting it at a good price. And I think people are so disheartened with the banks and demoralized as investors. That really is the time to think about buying.
Yeah. I guess one thing that always scares me about the banks, and I think other people, which is why you've bought in, because a lot of the market just sort of decide I'm not going anywhere near it, to no touch, is the sort of like potential black box syndrome. What's actually on their balance sheet, and Barclays has always looked a bit like it's got a lot of sort of like long-term assets, loans it's put out, which may be low interest rate, low return generating assets, and on that basis interest rates have gone up. It's effectively a bit like Bank of America. I wouldn't say it's anything like Silicon Valley, but there's a lot of unrealized losses on its loan book, which is longer term. But you'd have to be an expert to be able to go through that.
Yeah, I think it's part of the problem of I've mainly invested in smaller stocks, but in order to get yield and to get my overall PE, weighted average PE, lower, I've sort of have moved into stocks like Barclays and M&G, and they are much more difficult to understand. I'm a chartered accountant, and I struggle to fully, and also their annual reports. I've criticized Hargreaves' annual report for getting to 150 pages. I noticed that M&G has a 387-page annual report to go through. So yeah, they're a different animal. You're right; they have a very thin equity base. And they can fall very easily. They're not great businesses, really. But my feeling is that I certainly wouldn't be a buyer of any bank if the economy was thriving and doing really well, because that's when they make most of their mistakes. You remember at West, But now, when things have been so difficult and they've actually been so much more careful, then this is the time to invest in those kinds of entities. And it's not like my normal buy and hold forever kind of approach.
Yeah.
My view is with Barclays, when it reaches a certain price, I'll almost certainly exit. And if everything goes well with Keir Starmer's wealth creation plan and a thriving economy, I'm going to be the first out of Barclays.
Yeah, and also it has an investment banking angle to it as well. So if the IPO market comes back, particularly out in the States, then it should do well. Okay, let's move to the insurers. We've obviously got you own M&G, another one which is really, really cheap. In fact, this is so cheap. The dividend yield that 9% is higher than the PE ratio. So this is incredible value. Obviously, it's a life assurer and an investment house, etc., as people would know. Shares have been pretty poor. What's your latest on this one? Is it a bit like Barclays? It's just a super value financial.
Yeah, it's super value financial. I've PE of 8.4, growing earnings this year and next at 13% per annum, dividend yield of 10.1%. I mean, I've been in M&G for a couple of years now, but from the low £1, it was about £1. So I've done quite well with it, but certainly it's one of my worst performers in the current year, and it hasn't really taken off in the same way that some of my banking positions and Hargreaves, some of my other financials. It's got three key businesses: asset management, life, and wealth. The life business is largely the Prudential, where they run with profits policies. It's not the most exciting business in the world. There's been talk in the past of it being broken up into different bits and being sold off. They've got a restructuring plan. They all seem to have restructuring plans, as if they've only just discovered that the business wasn't as good as they thought it was, and yet they've been managing it for years. I mean, with this one, I'm a little less optimistic than I have been, partly because, again, if one assumes that markets are irrational, why have they remained so out of favour for so long? Maybe I'm arguing against myself and the Barclays and the position I took in Barclays. But I think that the positives are there is restructuring taking place. They're trying to breathe life into the life business, the Prudential business, by making it more efficient. They've taken about 200 million of cost out in the last year. I think it's going in the right direction. I would like to see value created by maybe selling off one of the divisions. And they've recently been able to enter into the bulk purchase annuity market, and they're hoping to build this up. They're hoping to do sales of 1 billion to 1.5 billion this year, and they're hoping that will fully offset the runoff in the annuity book that they have with the life business. So I think I can't say I know this business inside out. I don't know it like I might know Bioventix or one of the smaller stocks I'm associated with, but the current valuation, there's a lot that could go right with this stock.
Yeah, I mean, it does look extremely cheap, and I think a lot of people sort of struggle with the financials. I guess what it comes down to fundamentally is there growth in it, in terms of the competition and the regulatory environment and the risk associated with the balance sheet. We had a bit of a hiccup using Liz Truss's side with the life assurance, and I guess once people get more comfortable with that, then you might see a re-rating. Just on that sector, we've had a question. Dave W. He asks about Legal and General, which I think alongside M&G is another favourite of Lord Lee. I don't know whether you've had a look at Legal and General, which is probably pretty much similar, but it's a slightly bigger business.
Yeah, I mean, I've got a smaller position in Legal and General. I think it was quite an expensive breakfast I had with Lord Lee, because
okay. He tipped you, did he?
It's
crikey, the share. Just going to say the shares have had a bath, haven't they? He's not. Yeah,
the last few days they've had a real bath. It's the same kind of. I mean, I haven't got the valuations to hand. Maybe you have, but again, it's on incredibly high dividend yield, low multiple. Growing. They're what do they call it? They're people's capitalism or something. They've got a particular strategy to give wealth. Maybe it'll go down well with the Labour Party, but to democratise wealth. That's probably not. So I think they've had a change in CEO recently. The architect of their previous strategy, which I think was quite successful, is moving on or has moved on. I don't know the stock so well. It's only it's a much smaller position for me than some of the others.
Yeah, I was just looking at the numbers. You're right. I mean, it's very similar. The dividend yield's over 9%, and the PE is just over 9. So it's about, they're cash cows. They're just spinning out lots of money. I think the sort of successful track record in this area has actually come from Aviva, because I think you had a sort of a rock star CEO who started the restructuring there at the beginning of the pandemic, and I can't remember her name, Alison, I think, something like that, and she's managed to sort of like sell off some overseas businesses, restructure the UK, streamline it, take costs out, and it's basically realised a lot of sort of hidden value in the shares. And I think perhaps LNG, Legal and General, and MMG, if they actually follow a similar sort of track record, you might see more value, come out
John
of it.
calls them the Holy Trinity: Aviva, Legal and General, and M&G. I think both of us take the view that in a situation, particularly when we began investing in this area, so many of our stocks were trading on multiples of 20 and more, that value had to creep into some of these financials. We've seen it play out in the banking space, or I've seen it play out in the banking space. We haven't quite seen it work with the insurers as yet, so it will either work or it won't.
Yeah. Okay. Well, let's move on to another sector. The one you mentioned was Bioventix, which is a slightly more expensive stock, but has been an absolute winner over a long period. I don't know how long you've held this particular stock, but you'll take us through your latest view on this one. Does monoclonal antibodies that are used for healthcare and medical diagnostics, very niche, long-term or repeat revenue streams, high margin?
Yeah, I invested way back at £2.60. So,
well done. That's probably driven quite a lot of your returns then, because it's over £42 today.
Yeah, it's been the biggest contributor. It's been almost a life-changing investment, really. But what I recognised early on with it was that it was generating these huge operating margins, in the 80% level, that it had, as you said, recurring revenues. Everybody in the company could go to sleep for a year and revenues would continue to roll in. And once I met the CEO, Peter Harrison, my conviction grew dramatically. He's exactly the kind of manager I like. He under-promises, over-delivers. He's highly intelligent, but fundamentally honest person. Very capable. So when the financials are great and the management team are great, then you've got to go in and go in big. I later invested at £4.20, and I've invested all the way through to about £7 or £8. And I've had to scale back because the size of the investment would have dwarfed everything else. So I'm probably at less than 50% of my peak position. And I think the most exciting thing with Bioventix at the moment is its work with Gothenburg University and Professor Zetterberg on Alzheimer's. And as many of your viewers will know, there are companies such as Eli Lilly, Janssen, Alzpath, who are developing therapeutics. Actually, Janssen and Alzpath are, but certainly Eli Lilly are developing therapeutics.
Biogen's the other one. Thank
you very much. You dug me out of a hole there. They're developing therapeutics. Now, these therapeutics can improve something. I think the best one, improve the outcome, or can slow the growth of Alzheimer's down by 27%. But there are side effects, I know Eli Lilly are waiting on FDA clearance at the moment for their drug. Now, some of these two companies may have developed a diagnostic program to go with their therapeutic, and that's what a lot of these diagnostic companies are battling for, to try and get some of that market. But it's a complicated area in terms of identifying what's causing Alzheimer's. Is it linked to amyloid build up? So Bioventix are sort of covering the whole piece. They've got an investment in a business in Scandinavia that's focused on amyloid plaque, and they've developed tests, 3 types of tests. They've developed a p-tau 217 assay, to identify amyloid buildup. They're working on a p-tau PET assay, but probably the most exciting part is the work they're doing with brain-derived tau, which identifies neurodegeneration. So it allows you to monitor the progress of the disease. And their results on that are pretty good, very good, I'd say. And there's already rumors that they're going to be on the Quanterix platform. Quanterix are a maker of a relatively small machine. These assays that have been developed don't work very well on the big blood machines that most of the diagnostic companies supply to. So Quanterix have been able to take the lead by having this small machine capability. And I'm hoping by the end of the year, there have been hints, if you follow some of the presentations that some of the people at Gothenburg have been making around the world, they seem to be hinting that they will be on a platform by the end of the year. So I don't think the market has fully valued or fully understood what Bioventix is doing in this space. I mean, the shares peaked at £49 earlier in the year. They've been as low as £39 just a couple of days ago. I think, once we start seeing some announcements come through, then I hope that the confidence will grow that Bioventix will be one of the leaders in this and won't be left behind. But yeah, I mean, it's not just an Alzheimer's story. They've got troponin, which measures whether someone has a heart attack or had heart failure, and can be used for other tests for other potential illnesses as well. They've got vitamin D deficiency tests, which probably contributes half of their revenues at the moment. But in total, they've got a portfolio of around 20 antibodies on which they earn royalties of between 2 and 5%.
No, it's a brilliant model, no doubt about it. And I think you're right. I mean, I hadn't appreciated the opportunity in Alzheimer's, because if you think about sort of the aging population, if let's just say 10-15% of the population, unfortunately, when it reaches sort of like over 80, gets Alzheimer's or some sort of like neurological disease, and it's a fairly simple blood test to do, plus it's reasonably valued, then it's the kind of thing the government would screen for. You'd seen it, and in the very fullness of time. So to try and prevent earlier, prevention is much better than sort of like trying to cure it afterwards. So yeah, it could be absolutely massive over 2 to 3, 4, 5 years, because these things are they move glacial, don't they? A more sort of broader question, given you've sort of like you're 10 bagged or 20 bagged on it, etc., and obviously you've top sliced, is have you managed to even stay in the position? Because you say it's just been a huge winner and done so well for you. The temptation must be just to have banked all the profits, but you've been very sort of disciplined and run that winners, even though it's got bigger and bigger and bigger and top sliced, admittedly. But that's a real credit, that is, because you've seen it all the way up there, and you obviously there's lots of value potential upside.
Well, I think that's one of the reasons why I think I've done well as an investor. I don't have this need to I'm not a grabber. Maybe I think I'm going to live to 100, but my view is always thinking long term. And maybe I'm lazy. I don't want to constantly be looking to try and find the next Bioventix. If I've got a great investment, the chances are it's better to stick with it and take the risk that I sell it and buy something that I could lose my money on. So actually, I've had to be, every time I've sold, it's been kicking and screaming, because I at one point it was 30% of my portfolio, and it's just too big a position. And I think I really recommend your listeners to really focus on finding a good company, and as long as all the metrics and everything keeps supporting the story, and that's a big if that keeps happening, then why not just stay with it? You're going to have a few years where growth might be pedestrian, the share price might not do anything, but you've got to think longer term. Is this a good business? Yes. Has it got strong moat? Yes. Are all the financials good? Yes. Well, why sell?
Yeah. No, that's very wise words. That I know Warren Buffett, he's that view, doesn't he? Hold stocks forever because And that's what it's worked with sort of like Apple and Coke and places. Okay, another one in that sort of sector, which has been an absolute workhorse, as I'm sure you've done, you've done really well. It's Novo Nordisk, which is really a specialist in diabetes, but has now moved into GPL-1 drugs, which probably the viewers know are the anti-obesity class of therapeutics. I think they make Wegovy. And it's really them and Eli Lilly who are the sort of the two winners. But the shares have been more AI-like. They've just absolutely rocketed of late. What's your latest view on this, and also the sort of temptation to top slice and take profits on a stock that has just been brilliant?
Well, I bought into this in 2017 at around 17. This is using the US price.
Yeah.
It's $17, and it's now $141. So almost eight bagged. I've almost eight bagged my money, and I'm not sold a single share. It started off as a smaller position than Bioventix, so it hasn't. Although it's the biggest position in my SIP, it doesn't dominate. It's now, I think, the second biggest position overall. It had the last few good days and pushed ahead of Beazley, which was my second largest stock.
Yeah.
Bioventix being my first. Why do I like it? Well, look, earnings per share growth for the current year is penciled in at 23.6%. Next year at 22.6%. Operating margins are 45%. Return on assets, 32%. I mean, this business is a cash-generating machine. Now, there are risks. I do worry about the side effects of Wegovy, but the impact of Wegovy is significant. I think it's about a 15% weight loss, if I'm correct, and that is quite material. Unlike the story with Alzheimer's, where there may be a 27% slowdown, well, you've got side effects. There's a more of a trade-off there. For instance, I wouldn't do a diagnostic test in Alzheimer's today until I knew that there was a better treatment out there in the future. But in the case of Wegovy, if people are obese and they need to get their weight down, then clearly 15% reduction is very, very significant indeed. But of course, it's not just being bought by those who have got health problems. It's being probably bought by those people who just don't want to go to the gym, but want to lose a bit of weight to get into their clothes for a Friday night out. So it's more recreational. That is a worry as well. But Novo Nordisk have done a lot right over the years. Clearly, they're benefiting from the growth in diabetes. I've seen it firsthand. My mother's got type 1 diabetes. She's using all their products every day. I would love it if we didn't have a world with diabetes in it, and if people weren't getting obese. But clearly, that's a reality not created by Novo Nordisk. They're responding to it. Their own. I think the charitable fund that owns a big part of Novo Nordisk is another thing that I like. I like that link. It provides stability to the business. So yeah, I haven't sold a share, and I won't do for some time. In fact, I think it's really good value at the moment. I think you've got some PEs down here. I think it's 33 or something.
I get about 40, but even so, I would say when the market is sort of like, I think the S&P, for instance, trades at roughly around about, I don't know, let's say 21, 22 times. I think Eli Lilly, the last time I looked, was at 35, 40, etc. So it's about the same price as Eli Lilly. I mean, I think the key driver when it comes to sort of valuation is what the earnings, you think the earnings increase is going to be, how much profit. And I think with the likes of sort of like, the GPL-1 drugs, they can be used for sort of like chronic kidney disease, potential heart disease prevention as well. That label widening could expand significantly. So I guess when it comes down to the key killer question for you is that you don't plan to sell, obviously, but it's sort of like how have you rationalized that in terms of sort of just the financials getting an acceptable valuation? Because 35 times isn't traditionally cheap, but actually over 5 years, it might be really cheap.
Yeah, I mean, I don't own another stock rated at so highly as Novo Nordisk. I haven't historically. In fact, Bioventix have never been up at those heights. So it is trickier to hold. But when you look at the growth that's coming in and the way that PE ratio drops down over the next 5 years, then in my view, it actually still looks good value.
Yeah. Well, I'm not sure it's going to be a takeover, because I think it's already the Europe's biggest company, isn't it? Amazingly enough.
It's always worrying, isn't it, when a company becomes bigger than the country.
Yes.
We had it with Nokia in Finland,
Yeah.
and we're now having it with Novo Nordisk, and Denmark. But it is a worry. So at some point, I will take some profit, but I just my
No,
gut
I think you're wise. I mean, it's a rocket ship. The momentum's moving it up, and everybody loves like GPL1 drugs. No doubt about it. Okay, just remind the audience, if you want to put any questions to Leon, then whack him into the chat. But we've had one which is more for me, I think, this time. It's from Rich P, just asking about Equals Group. And this is an international payments forex provider. It came out with an update this week in terms of the strategic review process, which has been going on for about 7 months. It just extended that by another 28 days to 4 weeks. Basically, it said that one of the interested parties, Madison Dearborn, had dropped out, and there was still another interested party, Tower Capital, who are involved. And Dave's just asking my view. This is my biggest personal position. I've been a holder for a long time. My instinct is that essentially the valuation of Equals has increased over the last 7 months because the business has been performing really well. It has said it's trading in line with expectations, but given the disruption and the sort of sogginess of the UK market, that's a pretty damn good result, because it's sort of like year-on-year increases. So I think the valuation of the underlying business is at least, as good as it was before, if not higher. And I think what it comes down to is that this is a high quality, fast growing asset, that there's willing buyers and there's willing sellers, but there's a gap in the price in the price expectations, the valuation between the two, and that needs to be sort of like brought together. But that'd be my take. I don't know if you've been following this one, Leon. I guess you probably haven't, but
yeah, well, no, I have. I noticed one of your agenda points is any recent exits.
Oh, okay, you've recently topped. Okay, yes.
And so I sold on that announcement.
This week.
Away, yeah. I think. And I've come to this view quite slowly, but I have been saying consistently to friends who are invested, don't get too excited. Don't buy into this story that you're going to see a takeout at 170, 180 with that kind of number. And that's because of the nature of the people involved. I don't know much about Madison Dearborn, but that they've now pulled out. That leaves the bidding with Talbrook and a partner. Now, I previously was in corporate finance, and I've worked on deals with Talbrook.
Oh, right.
They're very sensible people. I've got no information, obviously, from them, but they're sensible people that don't like overpaying. And you might recall a few years ago, the AA group were listed on the stock market, and Talbrook took them private. And at a pretty low price. And again, I remember the discussions at that point, people building up great hope, because AA had come down from a very lofty price because it had too much debt and all the rest of it. And I think it dropped close to £1 or something. People were thinking they were going to see 150, 160. Luckily, because I'd bought in quite low, I was happy, but I think the offer came in the 120s. So what I suppose I'm saying is don't build up your hopes, especially now as the competitive tension has gone. They are the only bidder that we know of. The other thing about the business, the Equals business, is that I haven't quite appreciated the nature of some of its clients. It's fair to say that they're probably at the riskier end of the compliance spectrum. And for a buyer to get comfortable with that, I mean, we've already had 8 months of extensions in DD. And that's telling me very strongly that this isn't a straightforward business to understand and to evaluate. And there's clearly some compliance and regulatory issues that are worrying the bidders. We don't know why Madison Dearborn backed out. Maybe it was due to that. So, yeah, I was selling on the announcement. a good friend of mine, David Strader, then phoned me up to tell me that he'd been buying them, and I realised that it would be much better had we spoken, because we could have cut out the middleman.
Yeah.
He was buying everything I was selling. So I think a bid might emerge, but I don't think it's going to have the shareholders jumping up and down with great joy.
Yeah.
Also, the other factor is, I get the feeling that management wants out for some reason. I know the underlying business continues to do very well, and they've got some massive growth forecasts for this year according to Stockopedia. But my impression is that guys who are running that, I think they're in the mid 60s. They've got to think to themselves, what kind of business is going to be buying our business? And also the multiple. I mean, I think it's on an 18 times multiple. I don't think many PE houses pay that kind of money for businesses. If you think about the usual PE model, they're buying on 9 to 12 times, something like that. They push a whole lot of debt into the structure, and they get their returns from the debt repayment and the improvement in the underlying performance. So here, if they come in at paying top dollar, they're only getting the improvement from the underlying performance of the business. They're not going to really benefit from having a re-rating if they can improve the business and get debt down. So good luck.
You raise some really good points. I would add. I mean, I've interviewed Ian a few times, and they've been putting a shed load of money into over the last 3 or 4 years into all this, regulatory compliance and all this sort of stuff. And actually, I think they're one of the best in class operators in this sector for regulatory and compliance. In fact, I'm absolutely sure they are. So I'd be surprised if there is an angle in terms of that, which is stopping, the bid. If it was, they'd have come out earlier, I'm sure.
Why has it taken so long, Paul? Why is it taking?
I personally think it's price. I think it's basically because the shareholders have pushed the price up because the business is doing so well. And I mean, one instance which is again another value driver is that Madison, yes, it's pulled out the auction, but they own MoneyGram International, their big payments platform out there, which is absolutely huge in the States. Now, if they have a commercial agreement, which is what they're discussing, then you could use the payment rails for equals for MoneyGram, say in the States, or even if MoneyGram wants to come into the UK. So all I would say is that your value, when it comes down to valuation, 18 times, yes, may look optically expensive, but when you look at it through a lens of a PEG ratio, it's about half. I mean, the EPS is growing at over 30% per annum because sales are growing at 15% per annum. I think that's why there is a gap between value, and I don't know whether that is I could just be like you. I'm in the dark. I really don't know. But let's wait and see. I actually think.
I mean, I'm just going to say that. I mean, I've said this to another good friend who was also invested the best as I was, and I mentioned my portfolio.
This is Paul Scott, is it?
No, but I mentioned that my portfolio had peaked in April 21, and that's because the shares of best of the best had got to £32. But if I recount the story there, you might recall that management at Best of the Best did a strategic review, and that led to the shares begin their rise up from £6 or £7, I can't remember exactly, into the low teens. And then they announced that those conversations had ended. Again, quite lengthy. Any conversations they were having had ended, and that they weren't going to sell the business. And then COVID came, and the business started reporting better and better numbers. And that drove the share price up. In fact, management took their beach money off at £22 selling to institutional investors, and the shares carried on beyond that point. But actually, the key message there was that the people that had looked at the business had decided that the value of the business was, was a lot less than the public markets were valuing at. Because they had the opportunity of looking much closer than us, because as we said, what do we know really? They've been able to kick the tires. They've been able to get the DD done, and for whatever reason, Best of the Best never received an offer. And we all know that in the end, it got bought out at what was it, 5.30 by Israeli guy, and we were all very, very upset by that outcome, especially when so much had been hoped for. So I hope you're right.
Yeah. No. I mean, the one big difference between best of the best and equals. I mean, there's lots of differences in different sectors and different sort of like what they do. But one of them was just look at liquidity, because I can remember looking at best of the best and just getting £10,000 worth of best of the best was a struggle before, and that's unfortunately what drove it during the pandemic. It had no liquidity, and you had a shed load of people at home playing spot the ball. So, it just drove the price to crazy levels. Whereas there's a million shares traded every day in equals, which is, totally different. I mean, that's over 100 million shares, 100 million pounds turnover. But hey, you're right. Let's wait. It was a good question, actually. So thanks for Rich P for asking that. We've got another one follow up from Nicholas. Yeah, it is. Yeah, another one from Nicholas Slater. He says, this is for you, Leon. He says, with huge gains in some of your holdings and with CTG likely to rise, are you tempted to top slice if obviously Labour come in, because they may put up the price of capital gains tax?
It might surprise some viewers, but almost all my investing wealth is in ISAs and SIPs. And anything that was outside of it went to fund the house I'm in at the moment. Okay. So at the moment, I have very little outside of my ISAs and SIPs. But I do have, I've maxed, which is why my worry at the moment is what will happen to ISAs and SIPs going forward.
Yeah, no, I've got the same, not the same issue. I've done the same. Most of my money is in ISAs and SIPs, and
or I use spread betting. If I'm doing a lot.
You don't seem to be a spread better kind of guy, but hey.
No, well, but sometimes you for tax reasons it might make sense.
Oh, okay, yeah, to hedge it or whatever, yeah, okay.
But I have to say, as a warning to anyone thinking of doing it, the interest they're now charging on holding position is so high that literally I've got very little with them at the moment. Yeah.
Another one from actually Nicholas. He says, any view on Card Factory, Leon? I see it has a 91 on the Stockopedia ranking, which I presume is high.
Well, I know nothing about Card Factory, but now that Nicholas has mentioned it, I'm certainly going to take an interest in it.
Okay. I think it was used to be a Cockney Rebel, Richard Crowe special, and I think that they manufacture their own cards, which is different to most of the sort of the card shops. And
it hasn't changed its name from something.
Yeah, there was one. Clinton Cards went bust as well, so it took a big competitor out. But I guess it just comes down to execution on the high street. It's pretty it's pretty tough.
I mean, I can look at its. I'll have a quick look at its on Stockopedia and.
Yeah.
If you.
Yeah, there's one of them. Look, and I'm guessing it's a question from Dave W. He's asking about Him and Hers Health. Hims. Do you know anything about this one at all? I've never really come across it. I think is it a US company?
Yeah, it is. I've just looked it up.
Yeah,
it's
done pretty well, but I'm gonna personally I can't add anything because I don't know anything about it.
Yeah, I mean, I've seen a lot of its promotions on TV and elsewhere. But it's trading at its market cap's 4 billion, PE of 104.
Is it a telehealth business or something like that?
No, I think what it does is it brings together products related to the bedroom.
I see. Very politely put.
So I think all I remember seeing is a nicely packaged product.
Okay.
Yeah, as well. But I might have got this completely wrong. But I mean, looking at its revenues, it's growing dramatically. It's 3 times revenues in the last 3 years. It's up to close to $1 billion of revenues by 23. They're predicting 1.2 billion of revenues in 24. But and they're reducing their loss, 115 million loss in 21 down to, I think they're saying, a profit they're forecasting for the current year. So it's certainly one to look at. It might be interesting.
Yeah. Okay. Peter Faulkner says, got to check the online reviews on that one. So I think that'll be fascinating for some research later on. Okay. Well, let's move to the final one. It's to advanced ADVT, which is, I think it's headed up by a rock star exec chair lady, actually. I think Vin Murray, who has got a great track record. And she set this up as a SPAC about, I don't know, 3 or 4 years ago. And she's steadily been buying IT firms, software businesses. I think she made a recent acquisition as well. She got about the business got about 10% stake in M&C Saatchi. What sort of you attracted to this one? Because it seems to be really betting on her, I suppose, rather than the current business, it is growing. It's got revenues of 35 million compared to a market cap of about 200.
Yeah, I mean, I've known of Vin Murray. I've met her a couple of times as well for a good decade now. And you remember that she had a business listed on the stock market that did really, really well. She's sort of then got involved in private equity, and now she's found this vehicle, and they looked at a number of businesses. I did get involved in the SPAC when it was placed, and they were looking at a particular deal that sadly fell apart. In the end, I sold out and then had to buy back in after the Capita deal. But no, I think she is a whirlwind, Vin, of energy and intelligence and ability. And, sometimes you've just got to back people. And she's got built a great team around her. Also, when I was doing corporate finance work, I did a lot of work on acquisitions with Capita. And then I've followed its sad story over the last 5 or 6 years, where they've been getting rid of a lot of the businesses. In fact, quite a few of the businesses that I helped Capita to buy. And
so they can blame you, can they, Leon?
Blame me. I drove the Capita price from 20 to 14 pence single-handedly. No, I remember at one point telling Paul Pinder, him telling me that I was responsible for 40% of Capita's revenue. But those days were a long time ago, and the business continued to make lots of acquisitions, and it does contracting and acquisition orientated. And I think it just got too big and unwieldy. So the new guy came in. He got rid of a lot of businesses. I think he's made it much more of a contracting only business. And in doing so, I think he's got rid of some decent businesses. And Vin obviously thought the same. She bought these businesses as 5 small software businesses, as you said, with 35 million of revenue, 77% recurring revenue for 33 million. Clearly the market cap at the moment needs a lot more than that one business, but she's got, as you say, her 10% stake in M&C Saatchi, which is worth about 23 million pounds. In total, the market cap is 196 million. There is a PE ratio out there for next year of 46 times, so it's not cheap. So actually, I lied earlier. This is my most expensive stock.
Well, how much value would you put on the sort of the leader on this one? Because if you just do a sum of the parts, I don't know, 35 million of turnover. Let's give it a 3 times sales multiple. You get 110 million. Let's put the 10% of M&G Saatchi in, which is about another 20 mil. So you got 130. At the moment, the market's baking in about a 60 million pound premium for Vin.
That's obviously a lot, but I don't know. Sometimes when things are small like this, it doesn't do to be too precise. And
okay.
I remember when I bought in at about somewhere between £1 and £1.10, I think. And I was speaking to someone who was saying, well, and they were one of the original investors who hadn't got out. But they were saying, but there's a 10% difference in the difference between we're paying a smaller premium, but it's still a premium. And I just thought that was, not quite the right way of looking at it. Clearly, the price of Vin has gone up a lot in the last few months. So I think we'd want to see now, some some progress with the existing businesses they've bought, some resolution to the M&C Saatchi investment. Doesn't seem much point carrying it on the balance sheet, and it doesn't quite fit either. I know they made an argument for why it probably has more software in it than more tech in it than, but I would like to see that gone and for them to focus on, and I'm sure they are looking at other acquisitions. And so I think that this will grow into its price. I think it's the well-known phrase.
Yeah. Well, she does some more smart acquisitions than I'm sure it was. Okay, we just got one final question coming from Ignatius Pinto. He says, any view on Finseta, which is basically another fintech international payments business, much smaller. The shares have done well of late, but are still sort of recovering, and they've had they've got a good sort of CEO put in place there who's driven a sort of turnaround in the business over the last sort of 2 years. The shares have responded. I think they're basically profitable and cash generative now. I don't know if you've had a look at this one at all, Leon.
Do you know what the ticker is?
Yeah, it's FIN is the ticker. I know basically the PEG ratio is well less than 1 because they're growing so fast. They're a bit like I think they do more white glove service type of forex relationships rather than straight through processing, which is equals. But they're in that sort of sector. They're mid between sort of like an Argentex and an equals. A bit smaller. I think the market cap is, I can't remember how much it is. Probably around about, was it 30-40 million or something? But their top line is growing at 30% per annum. Well, in fact, it doubled last year.
Yeah, no, I just had a quick look. I think the market cap's a bit less than that. So there's not much data on Finseta on Stockopedia. So definitely it's 16.7 multiple they've got that on, and their revenues forecast for 24 of about 11, growing to 14 in 25.
They'll blow through that 11 this year, no doubt about it.
So yeah, you probably know a lot more about it than I do.
Yeah. Okay. All right. Well, brilliant for all the insights there, Leon, and thanks everyone for your questions. And as I say, very much look forward in hearing your views again in about 2 or 3 months' time, Leon. So hope you have a good summer holidays.
And may all your equals come true.
Yeah, I know. We'll wait and see anyway. But it's only my largest position. So thanks again, everyone.
All right then. Thanks very much, Paul, for inviting me. I really enjoyed it. Thanks a lot. Bye-bye.